Existing home sales this morning come ahead of the expectations, despite those expectations already reflecting a recovering housing market in the shape of a V. Let's bring in Michael Shaoul back with us from Marketfield Asset Management. He's a CEO and portfolio manager and chairman. Mr. Shaoul, always good to have you here. So let's talk this morning's data. I mean, it seems like more of the same. This is like a suspiciously reliable trend now. How long can this go on?
I think the housing market has had a step up in activity post-COVID, which is going to be long-lasting. I think you have completed a very long period of below-average home sales. Existing home sales sort of got back to average, new home sales well below average, and that was for really 12 years. I think this is the new reality. We're back at, I think, at a sustainable pace of around maybe 6 million existing home sales a year. I think, I'm not sure that this month's pace is sustainable simply because inventory is running out extremely quickly. But the housing market is not going to go back to where it was pre-COVID. This is really a change which I think is going to be sustained.
And we're already pretty much there. I mean, this V has gone quite vertical now. The supply and the inventory situation is still one that means home builders should be building, but the stock prices over the last week have started to slip. Should we read into that at all?
I don't think it's a secret anymore. I mean, certainly data like this, is not going to have a short-term boost on the market, and earnings of the home builders have really been good this quarter, but again, had been fully discounted. So, I mean, it's hard to complain given the power of the move that the home builders have produced. And, we're in at the moment, a range-bound overall equity market, an equity market which has gone nowhere for about 6 weeks. But, I wouldn't call it a warning signal. I just think we've reached the point at which the market understands that this is a good housing market. Is pricing the home builders, still normal valuations.
Michael, can you give me some insight as to what decisions you've made? I mean, I know maybe you can't get specific on companies, but I know you've been long home builders. I know you've had this trade. Obviously, it's been a very rewarding one. Are you starting to take profits in any of them? Are there some that are obviously profit-taking opportunities more than others?
Yeah, I think it would be, if we made a decision, it would be more likely to be an across-the-board, an across-the-board decision that simply, the market had got to our point. But as I say, I'm not that bothered about, a group which may have a period of consolidation ahead of it, and may be choppy. Maybe the home builders are kind of where the precious metals were in August, which is, they sort of discounted an awful lot of good news and had to go sideways for a period of time. What would be more worrying is if, we found ourselves back in January 2018, where, again, the home builders had a tremendous 18 months and then went through an actual period of difficulty as interest rates went up and mortgage rates went up. I mean, right now, it's hard to identify the negative catalyst, with a possible exception of margin pressures. It's definitely builders' costs are going up. So far, they've been able to pass those on to the buyers of homes. There is a limit to that. There is a limit to that process. But as I say, I wouldn't call the builders a screaming buy anymore. I wouldn't be urging people to get involved in the way that we were in the second quarter of this year. Nor do I think I need to get out of them. I think there's far more excessively valued portions of the equity market than the home builders right now.
Okay. One of the things from economic data that people sometimes think about is whether or not sentiment gets too far as consumer behavior. What about from the home builder sentiment perspective? This chart here is showing us the most optimistic view of the home builders from the NAHB sentiment that we've had going back years. I mean, this chart goes way back.
Yes. Yeah, it is at a record. Now, it's important to know what this measures. This actually measures whether or not things have got better in the last month or not, and the percentage of builders saying that the present sales have got better and future sales have got better. So in a sense, it's more about the reality of the situation than sentiment. And what we find with this index is it doesn't have obvious implications as a contrary indicator at very high readings. So, you know, the prior peak readings were as long ago as 1998. You know, it's true that 98 through 99 got a little bit more difficult when mortgage rates went up, but the actual peak of that cycle was not until 2005. So as I say, it's more, I think, telling you that the market is now fully informed. I think it's telling you that things really have changed on a sort of semi-permanent basis. You know, in the second quarter of this year. But I wouldn't call it a negative signal. If this was consumer confidence looking like this, I'd be okay. You know, everybody's kind of all in at this point. But I don't think that's the case with the builders. None of the flow data suggests that the people have put excessive investments into this, into this space. So as I say, something can be fully discounted without being fully dangerous.
Okay. Okay, that's interesting. Without being fully dangerous, now obviously, as you say, they're not a screaming buy necessarily, the home builders anymore. Not a reason to bail either. The price of lumber has come down quite significantly over the last several weeks. What do you want to see in either the earnings from these companies or the data overall? What's the most important sign here that this is still going? Because there's also this topic of fiscal stimulus, which hasn't arrived yet. Does that matter for home builders, or are the people buying homes the ones that aren't depending on a check right now?
Yeah, I really don't think it matters to the builders. As I say, they're not going to be the recipients of the stimulus. May actually be net losers if a Democratic sweep takes place in terms of general tax policy. I think margins are going to be what matters. I think it's reasonable to assume that demand for housing is going to remain strong. It's reasonable to assume that there's not some sort of hidden block of shadow inventory in the existing home market that can compete with new homes. It simply doesn't exist at this point. So the question is, can the builders expand their volume while keeping prices under control? So far they've kind of managed to do that. As I say, where there have been cost increases, they've been rewarded by price increases in homes. You need to see that steadiness, and I think we want to see builders doing what they've been doing, which is remaining calm, not getting too excited, not bidding up land prices and building a large land inventory, not building significantly ahead of ahead of new demand. In fact, they've actually been a little bit behind new demand so far. As I say, if you see these big changes in behavior, that would be more of a warning sign. But as I say, at a time in which there's an awful lot of stuff in global equities which are kind of over-owned and overvalued, for builders, as I say, no longer a bargain, but perhaps a better bet than some of the alternatives out there.
Michael, we definitely want to make sure that I touch on some of the China economic research that you've been doing. Sure. Before I let you go here. For China, it seems there's a little bit of a more broad recovery. I mean, I could be wrong in that statement, but the overall year-over-year percentage now for economic activity as a whole is turned positive. Yep. Not as big as they were doing pre-COVID, of course, but turned positive. So when it comes to alternatives or investors looking for something besides paying up for tech, I mean, are we going to see more interest in manufacturing trades that are tied to China? I mean, this looks pretty good.
Yeah, I mean, the short answer is yes. I mean, we favor the Asia-Pacific region in general simply because it has been so much less disrupted by COVID. And this is true of China and Korea and Taiwan, to some extent Japan. They're also beneficiaries of the surge in demand for durable goods, which has taken place in the United States. Many of those goods are going to be generated in this region. And on top of that, domestic demand within China, has recovered pretty well. So I think this is the region to look at. At the index level, it gets complicated. Some of those indexes have a lot of technology, and they're going to have a lot of overlap with the S&P because of that. But as I think generally, if you're looking to diversify, Asia Pacific is interesting. Now, one of the strange things about the current environment is that strength in Chinese demand has not spread to all of China's typical trading partners. It has spread to its rivals like Korea and Taiwan, but you are not yet seeing any significant strength in a region such as Latin America. I don't think this dichotomy is sustainable. Either China's strength is going to ebb, the whole EM complex that has another correction ahead of this, or I think China's demand for raw materials is going to start to reflate. The troubled economies of its commodity providers, places like Chile and Brazil. So I think that's something to look ahead towards. I'd say these have been difficult things to own this year. They've not been terrible since the summer, but they've been volatile. It does. I can't think of a period of time in which China's demand for commodities has been as strong as it currently is, and commodity pricing is now reasonably solid in things like iron ore and copper. And yet, you look at something like the Chilean peso, the Brazilian real. These are still, remarkably discounted currencies.
Okay, and we definitely see the commodity bid in copper, at least, up at 315, down today, but just made new highs yesterday. Michael, good to catch up. Appreciate you coming on as always. Thank you.
Thank you.
Michael Shaoul is the chairman, CEO, and portfolio manager at Marketfield Asset Management.